Gold is bouncing up 1.6% here today. Really a solid start if we're going to see this level of support hold. Question now will be, you're fighting some headwinds now. Now that we've gotten, a little bit of a bounce going, the question is, are sellers going to come take this down from here? That would be the question, because of course you had just this, dominant upward trend, unbeatable uptrend energy, and then price comes down to, a couple key levels of support, can't seem to find it. We're now seeing a support level, but I think that the bulls have something to prove here. If we can get a break through these levels, a higher low, a breakthrough, then I think that's what you kind of need in order to confirm that the bull trend may still at least be intact. You have to remember, before you get overly bullish, that we had a bounce here that ended up just being sort of a reload for the sellers. So we'll see if that is another scenario here, if gold is going to do one of these guys, continue lower, or what would be more looking like a breakout would be, okay, you've got resistance here, we break through that, we start actually forming higher lows, higher highs, and then maybe we got something here for the bulls. In terms of gold, my personal opinion right now is I don't really have a strong directional bias. I'm not very bullish. I'm not very bearish. I think I'm pretty much just neutral. And part of the reason for that is that if we go into our categories and just select metals here, you can see gold is getting a -4 rating on the Edge Finder. Where are we losing points? Well, let's go look at the gold scanner for this, because I think that this tool is awesome and we might as well use it. So when we look at the gold scoring breakdown for the Edge Finder, let's look at where we're losing some points. Number one is that, so let's see, where am I looking? Right here. Retail traders seem very, very long-sided on gold right now, which makes me a little bit more cautious and slightly more bearish. When we know the retail crowd is very very long, then we know that sometimes can be a little bit of a retail trap. It's not always a perfect indicator, but it's something to at least pay mind to. So retail sentiment here, again, giving us a bearish reading. If we take a look at seasonality, it's not a particularly strong period of the year for gold. We can see that in our seasonality scanner here. We could go take a look at the full picture if we wanted to, but just for simplicity's sake, going through the score here, trend is to the downside. We've seen momentum pick up to the downside for now. So that has something to prove, and that could flip. I mean, if that flips to a +2, right? If you start seeing a really big bullish move, then that really changes the score quite a bit here by a factor of 4, right? It goes from -2 to +2. That would be a +4. That put us at neutral currently, or right at 0. So if we take a look at GDP numbers, right, we can go through some of the economic data quickly. Numbers did come in lighter than expected, which is a positive for gold. Manufacturing PMI was weaker than expected. That's positive for gold. Services were stronger than expected in the US, so less strong for gold. Same with retail sales, they were strong. Inflation getting a +1, employment change +1, unemployment. So what we can see here is that with gold, the overall score on the Edge Finder is giving us a -4. That actually leans bearish. It's a -5 is the threshold for outright bearishness. I like the downtrend potential, right? If we take a look here, we've got momentum here forming to the downside. The question now becomes, do we hold these levels of broken support as now resistance? We'll see. If any additional points go to the bears on this list, it's a good chance that I will probably be on the bearish side, meaning looking for opportunities to potentially get short. I wanted to narrow in on that seasonality for just a second. Also, let's go month of the year seasonality. We take a look at gold and you can see that this last period of the year, well, at least these 3 months, September, October, November, are actually seasonally last 10 years, the average negative performance. So when I look at gold, I actually sort of lean bearish for now. That being said, gold is up 1.6%. It's a great start for the day on gold. US stock market opens up in 3 minutes, so we'll probably get some volatility there. Bitcoin is up 0.4%. I'm still in my long position. Have not changed anything on this one. I'd like to see us trade and close above this high again. We did close. It was a very, very slightly higher than all-time high close on Friday, but we didn't really get any follow through. I was thinking we might see some just explosion through the highs, but for me right now on Bitcoin, it is just a matter of trailing stops. So I have my stop loss here. If we can, break through the highs, then I will go ahead and lock in something else. Tighten up the stop just a little bit more, but currently floating a pretty good P&L right now on Bitcoin. Cannot complain. I'll show you IBIT is the position that I actually hold open. IBIT is looking real strong on this trade that I took a couple weeks back. But we'll see. Silver up 2%, gold up 1.6%. And again, coming back to gold just for a second, basically, I don't have a bearish bias, but I'm kind of close to one. If I can tick any more boxes into the bear territory here under our gold and silver scanner, gold's going to put us here, put us into the bearish territory.
This was our best year yet at A1 Trading. In 2024, we brought the incredible Chris Pulver in and gave you guys access to all of his trades and analysis through Pulver Alerts. We also introduced our newest market scanner, the Stock Box, whose AI algorithm is scanning each and every day to provide you with bullish or bearish biases on the top stocks and stock sectors from around the world. Not only that, but the Stock Box gives you a behind-the-scene look at what the largest hedge funds in the world are buying and selling through the 13F scanner, so you can keep up with what people like Warren Buffett or Steve Cohen are adding to their portfolio. The best part of all, both of these products are on sale now for a massive 40% off during our Black Friday sale event. The Stock Box, the Edge Finder, Pulver Alerts, and the VIP Discord community, as well as our Trading View indicators, are all on sale for 40% off. This is the absolute best discount of the year, hands down. So if you want to take your trading to the next level, don't miss out on the 40% off Black Friday sale event. You can find out more with the link being dropped in the chat now. Again, 40% won't last forever, so take advantage of this huge sale. Stockbox, Edge Finder, Pulver Alerts, VIP Discord community, and Trading View indicators, 40% off right now.
Stock market probably just opened up. Let's take a look at that. So here's the US stock market. Was sort of pulling back here recently. And what I actually found interesting is that this was a bit of the post-election rally that we saw. Started right around here, right? Big push up. And I think we've retraced about 50% of that. Yeah, just about 50% of that post-election rally seems to have faded a little bit now. And there's plenty of things to get a little bit cautious about, right? I actually would love to be on a technical only basis. I love this chart. I love the idea of getting long the S&P. However, I don't really have the right setups right now. If I go indices here, let's take a look at indices. You can see we've got a +2 for the S&P 500. The NASDAQ and the Russell are minus scores. And we can actually pull up, let's do our indices scanner as well. And you can see why we're getting a little bit of a mixed reading here on the Edge Finder's output for indices. Actually, let me refresh this because it's loading weird. There we go. Okay, so you can see we're just getting a neutral reading. It's not bearish, it's not bullish. Put to call ratio is also very neutral. You got put call right in the middle. COT data is very mixed for S&P 500. Retail's pretty mixed as well. We take a look at the market sentiment survey that gets sent out each week. You can see 50% feeling bullish, let's call it, and 28% feeling bearish, 22% feeling neutral. In fact, this is actually getting weighted a little bit too bullish for my liking. So we'll see how that plays out. That sentiment survey is really interesting. I do like to just keep an eye on the sentiment of it to see what's happening. So CPI came in. It was not better or worse than expected. So that kind of just stays neutral. Same thing with core CPI. Manufacturing PMI was a miss. Services PMI was good. Retail sales numbers were good. GDP growth was a miss. NFP last time around was a miss, but unemployment rate neutral. So you can see we just have a very neutral economic outlook for the S&P 500. Seasonally, it's a good time, but I don't want to just put 100% of my eggs in one basket with seasonality, right? Seasonality during the month of November and December is the best period of the year. I've showed this, and I do want to, be meticulous about finding certain things that I want to buy. Specifically, like I could look into some sectors and use the stock box to look at some of that stuff. But for me right now, where am I going? I'm going month of the year trends. Let's look at the S&P 500 here during this time. S&P 500. And here's what I'm trying to get at. Historically speaking, November and December are great months to be long the stock market. Different methodologies for exiting trades. Some people use strict take profits and stop losses. Some people use stop losses with no take profits, like myself, and trail stops. Other people use no take profits, but they take partial positions off as the trade goes in their favor. There's always different ways to exit. I'm curious, Ivan, I know, but I'm for audience members, how do you choose to exit the market and why? I'm just curious.
Long story. I hope you have time. What I did was I went through all my past trades. I added them to the chart and said, okay, if I did 50, 20, 50, 100, 120 pips stop loss, what happened? So I found a sweet spot between 100 and 150. If I trailed, my profits started dipping, because you're wondering to yourself, why would that happen? Because emotion starts kicking in. Because if you see this drop here, for that matter, I would exit. But this is just one variance. Or I could exit here. That's kind of what generally tends to happen. Then the market went higher. What happens? Then I have to start chasing, and then, or I might not get entered again, and then I don't get my profits that I want. So for me, I found out that through data, through testing my own psychology and whatever, that having a fixed stop loss at about 100, 150 is best for me.
Yep. Yeah, and that's the thing is, like, within your own back testing, you found the right answer for your approach, for your strategy, and I think that's really key for everybody who's listening. And one thing I like to point out is everybody sort of has a way that they believe is better than others to close out of trades. Not everybody, but a lot of people will comment like, oh, well, you should be doing this. You should do partials. You should do trailing stops. You should do hard take profits. But the point is, there is always a scenario where you should have used a different exit, right? When the thing just goes straight in one direction forever, yeah, trailing stops are the best. When the market is back and forth, yeah, you should have taken full profits. And when it kind of does a slow uptrend, you want to just take partials, but you don't know which exact type of market that you're in. So everything has pros and cons. I always kind of point to the idea that whatever you choose, whatever you do in your back testing, as you just pointed out, stick to it and accept that sometimes it's still going to look silly compared to other methods, but you've done your back testing for a reason.
In as much as there's a couple of ways to this, and there's definitely a way to lose, but in terms of arrogance, right? Lose face in terms of arrogance. But when you, for yourself and for others, and what you kind of stick to, you have to test from time to time, because market changes, that if your strategy still works appropriately. But once you have done your data, once you have done whatever works for you and stick to it, it's kind of like, yeah, let's say that for me, trading salt would be a better idea, or whatever would be a better idea, then I should have found that in my back testing. I should have found that in my testing. That should have been, so instead of being like 70%, I can get like 80% if I do what I did, for example. Like if I can tune those extra percentages, I would do that.
You mentioned yen crosses. Yeah, I took a loss on euro yen, which is a little bit annoying. It's bouncing back, but we move on. We find the next one. Dollar yen, pound yen, all of these having a little bit of a bounce here today. Let's see. What about euro? Euro and pound. These things have just been falling to pieces here recently. Do you think dollar strength is going to cool off soon, or is this just are we just going to drive higher into the end of the year?
Define cool off.
Maybe like
Time.
maybe this is the top for the year. We pull back for the next few weeks.
Oh no,
You don't think so? You
not,
think this is,
not in my case. No.
you think we take out the highs?
Yeah. And then I asked you about time, right?
Mhm.
I can agree that this can be a short-term top for like a couple of weeks max.
Okay. Yeah.
But how do I explain it to you in simple terms is we have gone really quickly. Sorry, we have gone really quickly higher. We might have a range that we are creating now, but I think we're gonna find more Jews in December when inflation still doesn't come down. If and that's the only reason why we would go higher.
Yeah, that's a good point too. Is like the thing is when we look at inflation, we are at 2.6%. Meanwhile, when we look at inflation for other countries, you know, like UK, let's see if it'll load today. Let's take a look at GBP. Yeah, like look at this. There we go. CPI, 1.7%. So we look at the inflation story for the UK versus the dollar. I mean, it's no wonder these currencies are, you know, the forecast is probably shifting more towards these other central banks are going to cut rates. And meanwhile, the US central bank, the Federal Reserve, is less likely to cut so aggressively. So I don't know. That's a very simple, observable trend in the foreign exchange world right now. There's an imbalance, right? That's why the dollar is just sort of taking gains on all these charts. We look at USD CAD, it's up. Aussie dollar, it's down. That's strength for the dollar. Dollar Swiss even up, you know, quite a bit. Euro dollar here. So I kind of find I agree with you. Like it's hard for me to find the bottom on these moves. Like I wouldn't claim that that's the low of the year. We very well could just sort of continue. We have multiple reasons for dollar strength to be stubborn and persistent. We have the expectations that all these tax cuts and all of these tariffs that are coming into play could be largely inflationary overall. And we also have the central bank commentary on last week from Powell, basically saying we don't feel the need to cut. We're basically not feeling rushed to cut rates. We can take our time. We're not on a preset course. Market sort of took that as, okay, I mean, other central banks are gearing up for rate cuts. Meanwhile, Powell is saying we don't feel the need to rush.
If you're showing my screen now, wherever it is, I have written down some things. Why pound is falling. Well, Trump imposed tariffs coming. Taxes, increased risk with his presidency. Taxes is going to be increased a lot apparently now in the UK with the new budget, and among them inheritance tax, the yield, aka inflation, United States, Russia, now, or it can also call it geopolitical risk / Russia / whatever war we have right now. If that seems like over the weekend, this is a bit more heightened. And then the 5 is eco, that's economy. The weak UK economy, which 1.7, and the stronger economy in the United States makes this one very weak.
Yeah. No, I mean, I think, and some of the same things there impact Europe, of course, as well. So you just have this right now, a very strong fundamental case for dollar strength. And what would, as you just outlined with all those points, a change in those points would be what would have to take place in order for the dollar strength to really weaken, in my view. So if you get, we'll have to see how the tariffs, what does get passed, how strong they are, how maybe not strong they are, how restrictive are they to other countries, what does spending actually start to look like, which could be the inflation story. So I think right now the market is just saying, look, we don't know exactly, but we know it's going to be inflationary. Dollar just strong. And until we get something that changes that dynamic, story seems to be a lot of spending is coming. Stocks like that story quite a bit. And the dollar index also is stronger because, again, they're worried about inflation.
Just posted a trade alert in the Pulver alert section for the A1 Trading Discord. A little credit spread on NVIDIA. We have earnings this week on NVIDIA. Let me post some of the notables here. So this is the earnings week. It's pretty quiet overall. We have like 130 companies, 131 stocks reporting. These are some of the ones that I'm just paying attention to. I'm not doing a crazy amount of earnings reports for them. I have some exposure already on Walmart. We can take a look at Lowe's. That's had some big ups and downs. Home Depot and Lowe's both. Target, kind of the strength of the consumer. We got some tech plays with Snowflake and Palo Alto. I think I already had some profit on Palo Alto. BJ's is like Costco, so I'll take a look at that one. Baidu, I have some exposure on with the China plays. And then NVIDIA is going to be a big one there aftermarket on Wednesday. So I put in a simple credit spread. If price goes up on NVIDIA, great. That's easy peasy. I'm looking at this potentially to actually drop, though. Just for, hear me out. We have quite a large bar count between the last time we tested the 200 moving average, which is all the way back here in January 2023. So if we go all the way back here, we have stretched out around 461 bars on a daily time frame. That's quite a bit. And also percentage-wise, we had a nice reversion from the high here in June all the way back to that bottom in August. And that stretch was around 45% away from the 200 moving average. Now, it's been reduced a decent amount from this previous high. We're about 27, almost 28% away. But based on now the stretch of the bar count, I could see, I could see price gapping higher and then fading and just being like really choppy here, trying to make higher highs. We all know that NVIDIA is one of, several stocks that's kind of priced to perfection. It's been, beating expectations by leaps and bounds, and then it started to kind of slowly creep higher. And so that I guess the inability to show that it's multiplying by 3x and 4x. I mean, the market's like, hey, we're going to, we're not going to go gangbusters on NVIDIA to the upside and have these just exponential moves. So I think that the distance away from the 200 moving average, plus the 473 bars we've gone, it's going to be difficult for NVIDIA to go way, way, way higher. So here's what I'm doing. This is the trade that I just posted. This is a trade that I'm already in. I'm willing to take some shares of NVIDIA. My goal would be I want to own NVIDIA at 110 or less, okay, or less. So in order to do that, I'm going to use my 137 buy put and put in a profit target at $32. Okay, that gives me $32 of credit, which would bring me down from 137 down to 105. And if I were to get assigned at 138, take my 50 cents off the trade, take my $32 off on the long put, that brings me down to a break even of around 110 or so. 110.50 would be my break even. So 110.50 with previous highs near 150. That's good upside potential, plus some decent support around that 200 moving average or even into these August lows. So I am taking the trade with full intentions of wanting to own shares in case for some reason the market drops it. Also, the one thing that will be important to note on NVIDIA this week is it's a big enough stock at $3.42 trillion that whatever happens up or down, we could likely see some movement coming into Wednesday's close, because this is an aftermarket earnings report, or Thursday's open. We could see, potentially a 0.5 to 1% gap on the SPY and the Qs because of NVIDIA's market cap and how large it is. So it will definitely be a bit of a swinger this week on whether or not we are filling, gap-wise on the SPY. If we fill, use a box here, whether we fill this gap or whether we continue to backfill that election gap. Time will tell. Okay, so we still have some other gaps as well. The post-Fed meeting that we had back in September. I think all three of these levels are ripe for the taking. If I look at this chart right here, for example, let me float this out. So I could see price pulling back. Let's say price today is going to drift up here, find the open from Friday, maybe do a gap fill from Thursday's close to Friday's open on the SPY. If we find that level and we fade that level, question is, are we coming back into some fresh lows for the week? Okay, I'm going to remain hedged on my MES and my MNQ positions, which you can see those right here. So I have a long put at 60.25, and then at MNQ I have a long put. This is actually a long debit spread. So I bought the 21,200 put on the MNQ, and then I sold against that 800 points lower. So I'm looking to see if I can go $464 max risk for about a $1,100 to $1,200 max profit. And I'm looking to see if price will fall kind of deeper into my moving averages. If we have, the volatility somewhere between like 5 and 10%. Off these recent highs, we've had about a 4% correction on the NASDAQ. And let's go to futures here on the SPY or the S&P futures. We are down. We had about just shy of a 3% correction on the S&P. So could that get a little bit bigger? Yeah, sure. If, like I said, if we backfill more of the election stuff, then we could pull back 5, 7, 8. I think even up to 10% would be doable. I mean, if we come back to the 200 moving average on the S&P, this is E-mini futures, we'd have a 9.96% correction from top to bottom, finding that 200 moving average, which, by the way, we still haven't tested. This is also 200 and some bars away on the daily, which is, it's not crazy overextended, but it's something to certainly note. 262 bars. On top of that, it's the percentage away. So I talked about this with Nick last week in our November 12th session. We were 12% away. I have rarely seen any move on the S&P where we get anywhere between like 10 and 15%. We rarely get further away than that. I mean, somebody can test me on that, but anytime we've seen big moves away, let's actually have a look here. So how far away do we get on the downside? About 15 to 16% lower on the downside here. Same thing, about 15% lower on the upside. And we had this crazy run from 2020, which was our post-COVID crash melt up. We didn't see anything too much higher than maybe 10%. Yeah, there's 10% there. There was our top out, and there was a 9% move. COVID, I think we had like the outlier stretch because that was such a wild move. That was from low to high, stretched out about 20+% away, which was pretty interesting. This rally back up to it, about 30% to it. So that, I mean, again, I'd say COVID to be a bit of an outlier. That was the entire, world and global economy coming to a halt. Other than that, I kind of watched this 10 to 15% window. Going into pre-COVID, we were about 9.5%. You can see the crash right here towards the end. We were stretched away around 11.5%. So we're in the same ballpark that I've seen. I'm back into 2014 now, and every time we've seen it stretch away, like this is 2013, super smooth, lots of dynamic support, bull market, and we went X amount of bars. That was a stretch away of 400 plus bars before we ended up correcting and reverting back to the 200 moving average, and we got as high away as only about 7%. So I'm trying to look at some big fat outliers, maybe here on the bear market side during 2008 when things were obviously pretty terrible. We stretched away about 40 to 50%, which on the downside makes more sense. On the upside, it's rare that I've seen anything more than 15%. Okay, does that make sense? Let's see if I'm... All right. NVIDIA 150, matter of time. Yeah, I'm not betting against it. I'm just saying that I want to own it cheaper. There's a lot of stocks I wouldn't mind owning cheaper. NVIDIA is one of them. Netflix is another one. Meta is another one. Microsoft is another one. Google another one. It's like my plan for 2025 is a lot to do with high quality money makers, lots of cash, competitive advantage, and even if earnings are lackluster, we still have companies that would be like well positioned for some resiliency. Here's one thing I thought was interesting this morning. This is the 10-year bond versus the 3-month bond. So this is your 10-month or the 10-year 3-month. What I thought was interesting, this is straight off the New York Fed website. Probability of U.S. recession 12 months ahead of term spread readings. Now, this hasn't been updated, but as of October 2024, we were about 50 basis points away. The real-time feed, we're about 17 basis points away. So we're getting much closer from the 10-year and the 3-month, getting back to the zero line, which is, as I've said, a bit of a concern. We go back to the weekly time frame here. I talked about this for the last couple of weeks. This has been on the radar. So not only am I watching the 10-year bond yield, if that goes higher, I think that's going to be a problem moving forward, where it's just going to choke out growth. I mean, it's going to be hard to restructure any type of debt. It's going to be hard to borrow and your primary consumer financing for anything long term. If it's hinging on the 10-year bond yield and it's going higher, that's probably not a good sign. So I just have some cause for concern, and the 10-year and the 3-month, usually within about 12 months, I'm gonna use a different color. Usually within about 12 months of this going from inverted to disinverted, inverted to disinverted, inverted to disinverted, same thing here. These black vertical lines represent the start of a recession. Okay, the start of recession. Now that's according to like the fact of we're in a recession. Now, I don't know if the price action of the S&P is starting to go ahead of that, or if this is officially, the market's noting that we're in a recession, then we start to see a downturn. I would imagine that price is going to lead the way. So we'll probably see a turn in the S&P faster than that. But a couple things that stand out. This is the longest inverted yield curve that we've seen on this for over 40 years. This is also the deepest we've seen in over 40 years. So what does that mean? I don't know. I think this is something that's difficult to model, but based on this being an undefeated indicator of every time we've seen this go inverted to disinverted, there has been a recession that's followed.
Did you know we do a live trading show Monday through Friday with guests from all over the world? To get notified when we go live, click the bell button next to the subscribe button or check in at 9:30 a.m. Eastern Time. We have helpful, free content in the description below and on our website, a1trading.com. Thanks for watching today's video, and we'll see you tomorrow.